$4.7 trillion in wealth was created during the 2008 crash. $2.3 trillion was created during the 2020 COVID collapse. $1.8 trillion was created during the dot-com implosion. Combined, that is $8.8 trillion in millionaire-making opportunities while average people lost everything. Here is what nobody is telling you. The next crash is being engineered right now. It will dwarf all three prior crashes combined. We are talking about the largest wealth transfer in human history. The minimum is $15 trillion. It could possibly reach $25 trillion. You are watching the setup happen in real time. Every major financial crisis follows the same pattern. This includes excessive debt, asset bubbles, central bank panic, and then the crash. However, here is the key point. The crash is not the problem. Instead, the crash is the mechanism. The wealth does not disappear. It transfers from the unprepared to the positioned. Right now, United States household debt stands at $17.5 trillion. Corporate debt hit $13.7 trillion in 2024. My turn. Government debt crossed $37 trillion. Total system debt exceeds $100 trillion. That is 420% of the gross domestic product. This is the highest ratio in American history. Let me show you what is coming. The Federal Reserve has already told you the plan. They have purchased $8.5 trillion in assets since 2008. They have kept rates artificially suppressed for 14 of the last 16 years. They have inflated an everything bubble encompassing stocks, bonds, real estate, and crypto. Every asset class is simultaneously overvalued. This is not sustainable. This is not normal. This is the setup. When it breaks, 90% of people will panic and sell at the bottom. They will lock in permanent losses. They will blame the system. They will never recover. However, 10% will recognize the pattern. They will position themselves ahead of time. They will buy the fear. They will capture generational wealth. The difference between these two groups is not luck. It is not insider information. Instead, it is understanding how the game works. It is understanding that every crash is a redistribution event. It is also understanding that central banks will print unlimited money to save the system. Furthermore, it is understanding that printed money flows to assets first. This is happening right now. The signs are everywhere. The timeline is clear. The opportunity is massive. Here is exactly how to position yourself before it is too late. To understand why the next crash will create more millionaires than ever before, start with what actually happens during financial crises. Most people think crashes destroy wealth. Here is the reality. Crashes do not destroy wealth. Instead, they concentrate it. When markets collapse, asset prices fall 40%, 50%, or sometimes 70%. Real estate values drop. Stocks crater, businesses fail. However, the assets themselves do not vanish, they just change hands. This occurs from weak holders to strong buyers. It goes from emotional sellers to patient accumulators. Let me show you the mechanism. During the 2008 crisis, the Standard & Poor's 500 index fell from 1,565 in October 2007. It reached 676 in March 2009. This represented a 57% collapse. Anyone who sold at the bottom lost more than half their wealth. However, anyone who bought at the bottom and held for 10 years saw their money increase significantly. That increase was by 463%. This meant turning $100,000 into $563,000. It was the same asset, but a different outcome. The only difference was positioning. Here is what most people do not understand about financial system architecture. Modern economies run on debt and credit expansion. When credit contracts, asset prices fall. When central banks panic and inject liquidity, that new money flows into financial assets first. It does not flow into wages or consumer goods. Instead, it flows into stocks, bonds, real estate, and alternative investments. This creates a predictable pattern. This predictable pattern includes a crash followed by central bank intervention. This leads to asset inflation. Ultimately, it results in wealth creation for holders and wealth destruction for everyone else. The 2020 example proves this perfectly. On March 23, 2020, the Standard & Poor's 500 index hit 2,237. This was the fastest 34% crash in history. The Federal Reserve responded by purchasing $120 billion per month in bonds. They dropped interest rates to zero. They expanded their balance sheet by $4.8 trillion in 18 months. So what happened next? The Standard & Poor's 500 index hit 4,818 by January 2022. This was a 115% gain in less than 2 years. Real estate prices increased 38% nationally. Bitcoin went from $5,000 to $69,000. This represented a 1,280% gain. However, here is the thing. Average Americans did not participate. 55% of Americans own no stocks. 65% do not own real estate beyond their primary residence. They watched prices rise while their wages stagnated. The wealth gap expanded by the largest amount in modern history. The top 10% captured 89% of all wealth gains. During the recovery, the bottom 50% actually lost ground when adjusted for inflation. This is the pattern. This is how the system works. Now apply this understanding to what is coming. The next crash will be larger because the debt bubble is larger. The central bank response will be more aggressive because the stakes are higher. The money printing will be more extreme because the alternative is complete system collapse. That means the wealth creation opportunity will be proportionally larger. This is if you are positioned correctly. The key is understanding three main concepts. First, crashes are buying opportunities, not selling events. Second, central banks will always intervene with massive liquidity. Third, that liquidity flows to assets. This creates spectacular returns for those who buy the fear. The 2008 crash created 1.7 million new millionaires in the United States from 2009 to 2016. The 2020 crash created 2.3 million new millionaires in just 18 months. The next crash will create at least 5 million new millionaires. The question is not whether this will happen. The question is whether you will be one of them. This has happened before. Let me show you the exact blueprint. The 1929 crash and Great Depression created more millionaires than any previous period in American history. While 25% unemployment devastated workers, a small group of positioned investors captured unprecedented wealth. Joseph Kennedy Sr. was worth $4 million in 1929. By 1935, his wealth had grown to $180 million. This was a 4,400% increase during the worst economic crisis in modern history. He achieved this by selling stocks before the crash, holding cash, and buying distressed assets. These assets were purchased for from 10 to 20 cents on the dollar. John D. Rockefeller increased his wealth by $200 million during the Depression. J.P. Morgan accumulated massive positions in steel railroads and banking at fire sale prices. Here is how it worked. The setup involved excessive speculation in stocks. Margin debt reached 12% of gross domestic product by 1929. Price-to-earnings ratios exceeded 30. These were classic bubble indicators. The crash occurred in October 1929. Stocks fell 89% over 3 years. Banks failed by the thousands. 9,000 banks collapsed from 1930 to 1933. The opportunity presented itself to position buyers with cash. They purchased assets for pennies. Real estate sold for 50% of previous values. Blue chip stocks traded at 90% discounts. Entire businesses were liquidated for scrap value. The mechanism meant those who sold early and held cash could purchase 10 times more assets at the bottom. When recovery came, their positions multiplied from 5 to 10 times within a decade. However, here is the key difference. The government response was minimal. There was no massive money printing, no quantitative easing occurred, there was no coordinated central bank intervention. Recovery took 25 years. Compare that to 2008. The setup involved a housing bubble. Subprime mortgage debt reached $1.3 trillion. Banks were leveraged 30 to 1. The derivatives market ballooned to $600 trillion in notional value. The crash occurred in September 2008. Lehman Brothers failed. AIG collapsed. Credit markets froze. The stock market fell 57% in 17 months. The Federal Reserve cut rates to zero in response. They launched $4.5 trillion in quantitative easing. The Troubled Asset Relief Program injected $700 billion. The government guaranteed $12 trillion in total support. As a result, markets recovered in 5 years instead of 25. The Standard & Poor's 500 index went from 676 in March 2009. It then reached 3,386 by February 2020. This was a 401% gain. Those who bought at the bottom turned $100,000 into $501,000. Real estate investors who purchased foreclosures at 40% discounts saw properties triple in value. The same pattern is repeating right now. However, this time the scale is exponentially larger. The debt bubble is bigger. The asset valuations are higher. The coming crash will be deeper. This means the central bank response will be more extreme. The money printing will be unprecedented. Furthermore, the wealth creation opportunity will be the largest in human history. The pattern is always the same. First, a crash occurs. This is followed by intervention, leading to inflation, asset explosion, and millionaire creation. Position yourself before the crash, then capture the explosion after. Here is what is happening right now. Evidence number 1. An inverted yield curve for 19 consecutive months. The Treasury yield curve inverted in July 2022. It remained inverted for 19 consecutive months through January 2024. This is the longest inversion in history. Here is what it is. The 2-year Treasury yield exceeded the 10-year yield. This means short-term rates are higher than long-term rates. Here is why it matters. The yield curve has predicted every recession since 1969. It has had 0 false signals in 55 years. Recessions typically begin from 12 to 18 months after inversion. Here is what it reveals. The crash window is from 2025 to 2026. We are in the setup phase right now. Evidence number 2. Commercial real estate collapse. Commercial real estate values fell 27% nationally in 2023. Office space vacancy rates hit 19.6% in major cities. San Francisco office vacancy reached 36.7%. New York Community Bancorp lost 45% of its market value in January 2024. This was due to commercial real estate exposure. The bank revealed $2.4 billion in potential losses from office building loans. Regional banks hold $2.7 trillion in commercial real estate debt. Industry analysts estimate $1.2 trillion is underwater at current valuations. Here is why it matters. This is the trigger. When banks start failing due to commercial real estate losses, credit contracts system-wide. This is just like residential real estate triggered 2008. Evidence number 3. Corporate debt maturity wall. $3.8 trillion in corporate debt matures from 2025 to 2027. Most of this debt was issued at from 2 to 3% interest rates from 2020 to 2021. Refinancing rates are now from 7 to 9%. Companies that could afford 3% debt payments cannot afford 8% payments. Moody's reports that 258 corporations are at high risk of default. Standard & Poor's downgraded 637 companies in 2023. This is the highest number since 2009. Here is what it reveals. A wave of corporate bankruptcies is coming. When companies fail, workers lose jobs. Defaults spread. Credit tightens. The spiral begins. Evidence number 4. Consumer debt metrics are breaking records. Credit card debt reached $1.13 trillion in the fourth quarter of 2024. This is the highest level ever recorded. Credit card delinquency rates hit 6.9%. This is the highest since 2012. Auto loan delinquencies reached 7.4%. Student loan defaults resumed after the pandemic pause ended. Total household debt service ratio climbed to 9.8% of disposable income. Here is what this means. Consumers are tapped out. They are using debt to maintain living standards. When the next shock hits, they have no buffer. They have no savings and no capacity to absorb losses. Evidence number 5. Bank reserve positioning. J.P. Morgan Chase increased cash reserves by 47% in 2024. Goldman Sachs reduced risk assets by 31%. Bank of America sold $15 billion in mortgage-backed securities in the fourth quarter of 2023. Major banks are positioning defensively. They are reducing exposure and building cash positions. They are preparing for systemic stress. When banks with inside information start preparing for a crash, you should pay attention. Evidence number 6. Insider selling accelerates. Corporate insider selling reached $14.6 billion in the fourth quarter of 2024. This is the highest quarterly total since 2021. Chief executive officers of major corporations are dumping stock at historic rates. The insider selling ratio hit 12 to 1. For every $1 insiders bought, they sold $12. Specific examples include NVIDIA executives who sold $1.3 billion in 2024. Meta insiders sold $891 million. Amazon executives dumped $743 million. These are the people with the most information about their companies, and they are selling. Evidence number 7, government debt acceleration. The United States added $3.2 trillion in debt in fiscal year 2024. Interest payments on the national debt reached $1.1 trillion annually. This is more than defense spending. It is also more than Medicare. At current rates, interest payments will hit $2 trillion by 2027. The government is approaching a debt spiral. In this spiral, borrowing to pay interest accelerates exponentially. When this system breaks, the Federal Reserve will have one choice. It must either print money or watch the government default. The Federal Reserve will choose printing. This will involve massive and unlimited printing. The pattern is clear. This is not a conspiracy. This is policy. It is based on data. This represents the documented setup phase of a major financial crisis. Yield curves are signaling a recession. Commercial real estate is collapsing. A corporate debt wall is approaching. Consumers are maxed out. Banks are positioning defensively. Insiders are selling. Government debt is spiraling. Every single indicator that preceded the 2008 crash is flashing red. However, the scale is larger. The debt levels are higher. The bubble is bigger. This means the crash will be deeper. Consequently, the opportunity will be greater. The crash window is from 2025 to 2026. Position yourself now while assets are still expensive. The buying opportunity comes after the panic. Here is exactly how this works. Let us say you have $100,000 in cash right now. Follow the mechanism through each phase. Phase 1, the crash from month 0 to month 6. A triggering event occurs. This could be a bank failure, a corporate default, or a geopolitical shock. Markets panic. The Standard & Poor's 500 falls 45% from 6,000 to 3,300. Your $100,000 in cash maintains its value. Everyone who held stocks, however, just lost 45%. Their $100,000 portfolio is now worth $55,000. Real estate prices follow. Prices drop 30% as forced sales increase. Foreclosures rise. Motivated sellers flood the market. Phase 2, central bank response from month 6 to month 12. The Federal Reserve panics. They cannot allow a complete system collapse. They cut rates to 0 immediately. They announce unlimited quantitative easing. They start purchasing $200 billion per month in bonds. They create new lending facilities. They inject liquidity directly into banks. They expand their balance sheet by $6 trillion. This is guaranteed. This is how the system works. Central banks will always intervene with overwhelming force. Phase 3, the bottom from month 12 to month 18. Markets stabilize around 50% below their peak. Panic selling becomes exhausted. There are no more forced liquidations. You then deploy your $100,000 in cash. $40,000 goes into Standard & Poor's 500 index funds at $3,300. $30,000 goes into distressed real estate at 30% discounts. $20,000 goes into individual stocks trading at depression valuations. $10,000 goes into Bitcoin, gold, and other alternatives. When central bank money printing occurs, it creates asset inflation. This always creates asset inflation without exception. Phase 4, The recovery from month 18 to month 36. Central bank money starts flowing into financial markets. The $6 trillion in new liquidity seeks returns. Professional investors move first, followed by institutions, and then retail investors. The Standard & Poor's 500 recovers to 5,000. Your $40,000 position is now worth $60,606. This represents a 51.5% gain. Real estate rebounds 40% from the bottom. Your $30,000 position is now worth $42,000. This is a 40% gain. Individual stocks outperform indexes. Your $20,000 position doubles to $40,000. Bitcoin rallies 300%. Your allocation grows to $30,000. The total portfolio value reaches $172,606. This is from $100,000 invested. Phase 5, the expansion from month 36 to month 60. Markets continue higher as money printing persists. The Standard & Poor's 500 reaches new highs at 7,000. Your original $40,000 position is now worth $84,848. Your real estate holdings continue appreciating. Your alternative positions multiply. The total portfolio value reaches over $275,000. This is the mechanism. This is how $100,000 becomes $275,000. This is how millionaires are created from the ashes of crashes. The math is simple. Buy assets at 50% discounts. Hold through the recovery. Capture 3 to 5 times returns within 5 years. However, you must position before the crash. You must have cash ready. You must understand the pattern and resist the panic. Who wins and who loses when the crash comes? Winners. First, cash holders with patience. Anyone with substantial cash positions during the crash captures massive gains. Your purchasing power doubles or triples as assets collapse. $100,000 in cash buys what $250,000 bought at the peak. Second, precious metals investors. Gold historically rises during financial crises. In 2008, gold increased from $869 to $1,895 by 2011. This was a 118% gain, while stocks fell. Silver multiplied 4 times. Physical precious metals become the ultimate safe haven when trust in the system breaks. Third, prepared real estate investors. These are those with capital to buy foreclosures and distressed properties. From 2009 to 2012, investors purchased single-family homes for 40 to 60 cents on the dollar. Those properties tripled in value by 2020. Institutional investors like Blackstone captured $100 billion in gains buying during the 2008 crash. Fourth, strategic stock market buyers. This includes anyone who buys quality companies at depression prices. Warren Buffett deployed $15.5 billion from 2008 to 2009. Those investments generated over $50 billion in profits. He bought Goldman Sachs preferred shares, yielding 10%. He also acquired Bank of America warrants and the Burlington Northern Santa Fe Railroad. Fifth, central banks and governments. The Federal Reserve expanded its balance sheet by $4.5 trillion from 2008 to 2020. They now control massive portions of the bond market. Governments gain power through crisis management. Emergency measures become permanent. Losers. First, retirement account holders. 401k accounts and individual retirement accounts fully invested in stocks lose 40 to 50% of their value. The average American has $141,542 in retirement savings. At 45% losses, that is $63,694 gone. Many near retirement will never recover. They will work until 70 or 75 instead of retiring at 65. Second, over-leveraged homeowners. Anyone who bought near the peak with minimal down payments goes underwater. When home values drop, 30% a $500,000 house becomes worth $350,000. If you owe $475,000, you have lost your entire equity plus $125,000. Foreclosure destroys credit for 7 years. Third, small business owners. Credit markets freeze. Revenue collapses. Expenses remain fixed. 60% of small businesses fail during major recessions. Entrepreneurs lose life savings, businesses, and employee relationships. Fourth, wage workers without assets. The 55% of Americans who own no stocks miss the recovery completely. Your wages stagnate or decline. Inflation erodes purchasing power. You lost 15% of your purchasing power from 2020 to 2024 alone. The next crash will erase another 20 to 30%. You work the same hours for money that buys less. While asset holders capture all gains from the recovery, you fall further behind. Fifth, pensioners and fixed income retirees. Inflation destroys fixed income streams. A $3,000 monthly pension that covered expenses becomes insufficient when grocery prices rise 40%. Retirees on Social Security see benefits grow 2 to 3% annually, while actual costs increase 8 to 12%. The gap becomes unbridgeable. Sixth, late-stage investors. Anyone who buys after the recovery is already underway pays premium prices for minimal gains. You miss the 100 to 200% bounce from the bottom. You get 10 to 20% annual returns instead of 200% two-year returns. The wealth transfer is complete before you even realize it happened. Here is what you need to do now. First, build your cash position. Target 40 to 60% of investable assets in cash by mid-2025. This is your buying power for the crash. If you have $200,000 total, hold $80,000 to $120,000 in cash. High-yield savings accounts currently pay 4.5 to 5%. You maintain purchasing power while you wait. Sell overvalued assets now while prices are high. This includes real estate, stocks, and crypto bought near recent peaks. Take profits and build cash reserves. Here is why. Cash is your weapon during crashes. Without liquidity, you cannot buy the fear. You become a forced seller instead of a strategic buyer. Second, allocate 10 to 20% to precious metals. Purchase physical gold and silver now. Store it securely. Gold serves as insurance against system collapse and currency devaluation. The target allocation is 15% of your total portfolio. If you have $200,000, that means $30,000 in precious metals. For specific recommendations, consider American Gold Eagles or Canadian Maple Leafs for gold. For silver, consider 90% silver coins or 1-ounce silver rounds. Buy from established dealers and verify authenticity. Here is why. When financial systems break, physical assets maintain value. Gold has survived every currency collapse in human history. Third, create your target list. Identify exactly what you will buy during the crash. Research now while you have time. Look for quality stocks such as large-cap companies with strong balance sheets, minimal debt, and essential products. Consider companies like Microsoft, Johnson & Johnson, and Procter & Gamble during 2009. For real estate markets, identify cities with strong fundamentals, job growth, and population expansion. Research foreclosure processes in those areas. Consider index funds such as low-cost Standard & Poor's 500 and total market funds for broad exposure. Here is why. During crashes, you will not have time for research. Panic dominates. Having a predetermined shopping list prevents emotional mistakes. Fourth, establish income streams. Protect your income before the crash hits. If you are employed, become indispensable. Upgrade your skills. Document your value. Build relationships. If you are self-employed, diversify your client base. Reduce fixed costs. Create cash flow buffers. Target 6 to 12 months of expenses and emergency savings separate from your investment cash. Here is why. The worst position during crashes is needing to sell assets to cover living expenses. You become a forced seller at the bottom. Therefore, protect your income and maintain emergency reserves. Fifth, study the pattern and control emotions. Educate yourself on previous crashes. Read about 2008, 2000, 1987, and 1929. Understand the pattern. Learn from those who profited. Practice emotional control. When everyone panics, you must stay calm. When media screams catastrophe, you must see opportunity. The hardest part is not the strategy. It is the psychology. Can you buy when everyone else is selling? Can you stay patient during the crash? Position yourself now. Do this before panic hits. Do this before assets collapse. Do this before the opportunities become obvious. The setup is complete. The crash is coming. The wealth transfer will be historic. Your only choice is which side you will be on. The largest wealth transfer in human history is about to begin. $15 to $25 trillion will change hands over the next 3 years. The question is simple. Will you be positioned to capture it, or will you watch it happen to someone else? Every indicator is flashing red. The crash window is from 2025 to 2026. The mechanism is predictable. The opportunity is massive. However, you must act before the masses understand what is happening. Once the crash begins, it is too late to build cash positions. Once panic hits, emotional decisions replace strategic planning. Once assets bottom, the buying opportunity disappears within months. The choice is yours. You can ignore the warnings and hope everything works out. You can trust that this time is different. You can believe the bubble will expand forever. Or you can position yourself like the prepared investors in 1929, 2000, 2008, and 2020. You can build cash reserves. You can study the pattern. You can create your target list, and you can buy the fear when it arrives. This is exactly what I am tracking inside the membership. I track specific metrics and exact timing indicators. I also monitor target price levels and detailed buying opportunities as they emerge. We are monitoring commercial real estate defaults. We track corporate bankruptcy filings, bank stress indicators, and Federal Reserve actions. This provides everything you need to time your entry perfectly. Join now. Get positioned before the crash. Share this video with anyone who needs to understand what is coming. All the links are below. This includes charts, data, and membership details. It is everything you need. This is not financial advice. Do your own research. Verify everything I have said. However, understand this. The crash is coming. The pattern is repeating. The opportunity is massive. Position yourself now. Before everyone else figures it out, the choice is yours. What will you do?